It's late January, which means W-2s are hitting mailboxes and secure portals right now. In the past, you may have taken this form, added it into TurboTax, and called it a day. But as your income increases, especially if you're in the tech field, this form can be a minefield of important information that you need to double check before you file your taxes. I'm John McCarthy, CPA, and today we're walking you through 3 specific traps hidden in your W-2. There's the codes and boxes that generalist tax software like TurboTax will often miss. And if you miss them, you could be overpaid in the IRS by thousands of dollars. Let's start with the most expensive mistake that we see with our clients, the double tax trap. Oh, stop. Before you file your taxes, you need to check box 1 of your W-2. If you had RSUs vest this year, or if you exercise non-qualified stock options, that income is already included right here on box 1 of your W-2. And here's the trap. You're going to be getting Form 1099 from your brokerage firm where your stock options or equity comp is held. That will be a form either from E-Trade, Fidelity, one of the big brokerage accounts. The problem is the brokerage firm often reports your cost basis as zero because they don't know that it was on your payroll. And that's just the way the IRS reporting system works. But if you just hand these 2 forms to a tax preparer who doesn't understand equity compensation, you're going to pay tax on that money twice. Once as the wages in box 1 of your W-2, and then once again on capital gains on the 1099-B that you received on Schedule D. The fix for this, you must manually adjust the cost basis on Form 8949. This is a schedule that rolls up into Schedule D on your tax return. You need to adjust that to match what was taxed on your W-2. Don't pay the IRS twice. You'll want to take a look at the codes in box 12. I sometimes call these the secret codes. There's dozens of codes here, honestly, but 2 of them can directly impact your wallet. First, I want you to look at box 12 for code V. This stands for exercise of a non-statutory stock option. That's a lot of words there, but what that means is that you've had some activity with NQSO stock options during the year. If you see this here, that's good. That shows that those wages are included in box 1 of your W-2. And the spread between the exercise price and the fair market value of those options has already been added to your wages. So that's good. But once again, this is another problem that you're going to be receiving a 1099-B for these shares at the end of the year. And if you do, there's going to be a zero cost basis shown there as well. And so you want to make sure that you're making the adjustment to your capital gains reporting so that you don't pay taxes on those stock options twice. Another code to look for in box 12 is code W. This code stands for Health Savings Account Contributions, and this is the sum of any employer contributions to your HSA that you've received, as well as your employee deferrals, the contributions that you made to your HSA. You'll want to look for the total amount here and compare it to the maximum HSA contribution for the year. The contribution amounts for 2025 are $4,300 for a self-funded plan or $8,550 for family coverage. And so if you haven't met the maximum, if you don't see that full amount in box 12 under code W, it tells you you've got some additional room to contribute to an HSA for the year. HSA can be a powerful savings opportunity for you because unlike flexible spending accounts, which are use it or lose it, HSA accounts can be, that money can be saved from year to year, and that money can continue to grow in the account. So if you haven't maxed out under code W, consider a year-end contribution that can be made before April 15th. Finally, we have what I call the Job-Hopper Refund. This is specifically for anyone out there who switched companies during 2025. If you have switched companies, keep in mind that you pay Social Security tax at a flat 6.2% rate under each of your jobs, but it stops once you hit $176,100. This is a very specific amount, just applies to your 2025 limitation. It's indexed for inflation annually. But what that means is the most Social Security tax that you should pay in any given year here for 2025 should be $10,918. And so when you switch jobs, your new company wouldn't know about your old company. And so they start the clock over again at zero and continue to withhold the full 6.2% Social Security amount. So if you earned over this limit between the two jobs, it's very likely that you've paid more than the $10,918. And in fact, a lot of our clients will pay that twice if they switch jobs mid-year. There's nothing that you can do about this through your HR department because this overpayment is claimed as a part of your personal return. So if you enter your W-2 information correctly, make sure you're entering those Social Security amounts, you should see a refund on your return for the excess Social Security. Be sure you're double checking this so that you're not losing out on this potential refund. Today, we've gone over just 3 lines on a relatively simple form, but one that's got a lot of boxes and a lot of codes. We didn't talk anything about incentive stock options, employee stock purchase plan, multi-state filings, all of that stuff. The complexity can multiply pretty quickly. And frankly, the cost of guessing wrong is too high. So if you're looking at your W-2 and feeling unsure that you've been set up correctly for the year ahead, don't just hope for the best. We work with a lot of high income earners every day to turn these complex equity packages into a clear tax strategy. So if you need another professional set of eyes on your situation, you can book a consultation directly on my calendar. The link is right down in the description. I'm John McCarthy, and thanks for watching today.